Interesting career path watching technology move into real estate and mortgages. And now we're getting ready for AI. And that's why you want to be working with a non-QM lender because they can help you navigate that. Inflation is coming down. We'll see that in a couple slides. But keep in mind, that just means prices are rising more slowly. At the same time, the Federal Reserve started buying up mortgage-backed securities, dropped interest rates to zero, and I would not be at all surprised if we get close to 700,000 new home sales by the end of the year, um, because people are increasingly looking at those new homes instead of existing homes.
Good afternoon and welcome everyone to today's A&D Mortgage educational webinar. Today, as usual, is we're joined every 6 months by our good friend Rick Sharga. We're going to be looking at the fall housing forecast and see what is going to be happening so that you guys can help steer your business this fall. Obviously, we're going to talk about the elephant in the room that will be hopefully happening tomorrow. But before we get to that, let's go over a couple of quick groundkeeping rules or housekeeping rules. We have disabled the chat for folks, and we've also disabled your mics and video feeds so that you can get full attention to Rick. If you do have questions, feel free, please, to use the Q&A box and panel down to the bottom of the screen. We are recording this live right now, so we'll send recordings out within 24 to 48 hours, depending how quickly we can get it processed. So we're going to cover a wide range of topics, but first let me introduce you to A&D Mortgage for those folks who are not used to us, but I'll introduce Rick a little bit in just a second and give him his credentials. But for those of you who may not be familiar with A&D Mortgage, we are a non-QM lender. We've been around for about 20 years. We're going to be celebrating our 20th anniversary fairly soon. We deal predominantly with mortgage brokers. That's about 90% of our business is through brokers. We do have a small contingent of correspondent and retail lending, but again, mostly through wholesale. And we are backed by a company called Imperial Fund, and they allow us to both originate and securitize our own mortgages on the capital markets. And that provides us with a lot of the flexibility that if you are working with us, you probably have come to know us for. So we are licensed pretty much at this point nationwide. There's a couple of states where we are still missing, and in 40 of those states, you can do a business purpose only loan with us. So now that we've got all that out of the way, let's get to the really good stuff with our good friend Rick Sharga. Rick has done, I don't know, 5 or 6 of these with us now. Tell us a little bit again about yourself, Rick, and about the CJ Patrick Company, and then we'll kind of dive into the questions and your presentation and your data.
Thanks, Carl. Always nice to join you. I am running a small company called CJ Patrick Company that provides market intelligence primarily to real estate and mortgage companies. I have been working in and around real estate and mortgage data now for the last 25 years with companies like RealtyTrack and Atom Data, Auction.com, 10X, and of course Carrington Mortgage, where Carl and I met and worked together for a while, and so it's been a real interesting ride. First half of my career I spent doing work for technology companies, so it's been kind of an interesting career path watching technology move into real estate and mortgages, and now we're getting ready for AI to change everything, just like we had smartphones change everything and the internet change everything and desktop computers change everything in previous cycles. So very, very interesting times indeed. Carl, I can't hear you. I think you're on mute.
Yes, I am on mute because unfortunately one of my little animals walked in. Okay, so let's take a look quick. First, we'll go at the macro level, national economic outlook, kind of we'll winnow our way down to the broker level and see how things are going. So why don't you give us kind of a heads up on where things are looking in terms of GDP and the general economy, and we'll start sharing your presentation.
Well, thank you, sir. We're going to cover an awful lot pretty quickly. As Carl
Yep.
mentioned, the presentation is being recorded. The slides are available for anybody who wants them, and my contact information will come up at the end if you have any questions for me afterwards. But feel free to throw in some questions to the Q&A area, and we will cover them as we get through the presentation. But we're going to cover what's going on in the economy. We'll take a look at mortgage rates. We'll take a look at both existing and new home sales, which are critical for anybody doing purchase loans. We'll take a look at what's going on with inventory, and then just some observations on where I believe the market might be headed as we move forward. In terms of the economy itself, the metric that most economists use, sort of as a Reader's Digest snapshot of what's going on economically, is the gross domestic product, the GDP. And despite all of the concern about a potential recession, GDP continues to grow on a quarterly basis. Most recent quarter, the second quarter of this year that's been reported, we actually had an adjustment upwards to about 3% growth. So a lot of economists have been calling for a recession by now, and a recession technically is when you have 2 consecutive quarters of negative GDP growth. We last had that back in the early part of 2022, and that wasn't technically a recession, but likelihood right now, the consensus among economists is that we're more likely to see a soft landing than we are a recession. And what I will share with you is that the difference between a soft landing and a mild recession, which is likely what we would have had, is very, very minimal. In both cases, we'll see the economy slow down a little bit. In both cases, we'll see unemployment go up a little bit. Neither of them is disastrous from an economic standpoint, but candidly, it'll be a little bit hard to tell the difference.
Economic semantics.
It's a lot of it semantics. Yeah. Now, the other thing to keep in mind as we go through this is when it comes to the U.S. economy, to this GDP, about 2/3 of it, 67%, is made up of consumer spending. So when you see the GDP growing, it tends to mean consumers are doing fairly well. And we have a couple slides as we go through this that are kind of kicking up some red flags when it comes to consumers. So it's probably worth keeping an eye on as we move forward.
Okay.
One of those red flags is that unemployment is actually ticking up a little bit. We're now at about 4.2% unemployment, up from down to, I guess we bottomed out probably at about 3.5% unemployment. And interestingly, and not necessarily in a good way, long-term unemployment is also ticking up a little bit. And that's people who've been unable to find work. So just about 6 months ago, we had about 11 million open jobs and about 6 million people looking for work. That gap has narrowed significantly. The number of jobs still open, probably about half of that. And we'll see in a minute that we're getting more and more people back into the workforce. To keep this in context, however, historically speaking, if you have unemployment rates below 5%, most economists categorize that as full employment.
Yep.
So we're still at 4.2%. It's not a huge number. The Federal Reserve had been forecasting unemployment to get as high as 4.8, 4.9% this year, and they've revised their estimate downward. So they don't believe unemployment will get much above 4.3, 4.4% by the end of this year. So unemployment up a little bit, but not something to worry about just yet. The jobs numbers are a little bit more problematic. In June, we actually saw only 118,000 new jobs filled for the month. The numbers coming out from the Bureau of Labor Statistics. And they actually had to revise the last year's worth of numbers downward by about 818,000. So they overestimated the number of jobs filled by over 800,000. That's a big miss, even in an economy with an awful lot of jobs. So what we're hearing from these revisions and from these recent numbers is that the job market may not be quite as robust as what we were being told. Again, unemployment numbers still looking pretty good. We're still net positive in terms of jobs being filled. Something else to keep an eye on is that little squiggly gray line you're looking at there. That's the labor force participation rate. That's the percentage of adult individuals who are either working or looking for work. And that dropped fairly significantly coming out of COVID. and is not fully recovered yet, but we are seeing more and more people coming back into the job market.
Mm.
And that probably has a lot to do with the cost of living being as high as it is, and families that have been trying to get by with a single source of income, now looking at dual income opportunities or necessities. So we are seeing that labor force participation rate come back a little bit, which means we have more people looking for work. And that's something that will inflate the unemployment numbers just a little bit. As more people come on board looking for work, it takes them a while to find that next job. And so that number goes up. But bottom line here, unemployment up a little bit, fewer jobs being filled than what we've seen in the most recent couple of years, and more people looking for work.
So is that a pink flag for you or a red flag?
It's a little bit of a red flag,
Okay.
and there are some concerns about the nature of the jobs being filled, Carl. We
Hmm.
have an all-time high in terms of part-time employment. We have a lot of people who are kind of working gig jobs in this gig economy.
Yep.
And that's something for mortgage brokers and loan officers to keep in mind is, today's borrower probably has a very different income source than what you've seen in years past. And I know we're still trying to figure out as an industry exactly how to handle this gig economy, but it's an important consideration.
Non-QM.
Um, and that's why you want to be working with a non-QM lender because they can help you navigate that. There's your plug, Carl.
Yeah.
So another red flag, consumer debt's at an
Yeah.
all-time high. I'm showing you only three measures here. One is credit card debt, which is sitting at roughly $1.3 trillion. We have about $1.6 trillion in auto loans, and we have another 1.5 trillion dollars in student loans. All told, there's about $18 trillion in consumer debt out there, all-time high.
Mm.
13 trillion of it is mortgage debt, and we're not as concerned about that because that debt is offset by a record amount of homeowner equity,
Hmm.
about $34 trillion. So that part isn't a problem, but we're looking at consumer debt in other categories, credit-related categories, at an all-time high during a period where interest rates are higher than they've ever been before as well. So
Yep.
that credit card debt I'm talking about, the average interest rate on a newly issued credit card today is somewhere between 25 and 30%. If you
Ouch.
have a department store card in your household, you probably have recently received a note from them telling you that interest rates are going up to 35%. These used to be interest rates that would get you arrested, or
Yeah.
were only available from your good friend Vinny down the street, who
Usury.
would collect with a baseball bat. And by the way, I'm Italian, so I can say that you can't. But just to set the record. So this is definitely a red flag, and this is happening at a time when personal savings rates are almost at all-time lows.
Hmm.
So if you're looking for red flags in the economy right now, my concern is that people are tapping their credit lines, are exhausting their personal savings accounts in order to make ends meet.
Yeah, for just regular
And
inflation.
yeah, we've seen this movie play out before, and the ending isn't very much fun. Inflation is coming down. We'll see that in a couple slides, but keep in mind that just means prices are rising more slowly. They still had that huge bump a couple of years ago.
Mhm.
I've created my own CPI because I don't like the government's consumer price index. My CPI is the Costco price index,
Yep.
and the salmon that I bought at Costco a year ago cost me $9.99 a pound. Today it's $12.99 a pound. So that's not a 2% or 10% increase from an inflation perspective. It's a 30% increase. And that's what
Yep.
a lot of households are facing when it comes to food costs, to gasoline costs, to energy costs,
Yep.
just
Even,
the necessities.
even my cup of coffee went up like 20%.
Oh, it's insane. It's
Yep.
insane. And probably no surprise given what we just talked about,
Hmm.
delinquency rates are rising pretty much across the board. This is a report from VantageScore.
Hmm.
And they blend together credit card, auto, student loan, mortgage, and other consumer credit.
Hmm.
And what we're seeing is a slow but steady increase, mostly in the 30 to 60-day delinquency rates, but really across the board. So it's not, again, Not as bad as what we saw back during the Great Recession, but certainly trending in the wrong direction. Tomorrow, we'll see how good
The
a
day
we'll see how good
the
a
day we've all been
prognosticator
waiting
I am,
for.
Carl. So I just wanted to kind of give you an idea what the Fed has done relative to inflation over the past decade.
Hmm.
And if you see the gray shaded area, that's the rate of inflation. And for a while, the question was whether we could get inflation up high enough to meet the Fed's numbers.
Yeah.
And then coming out of the pandemic, it skyrocketed to about 9%, which is the highest it had been since the 1980s. And it happened virtually overnight. Now, the government, the Federal Reserve, will have you believe that's all due to supply chain disruption and the war in Ukraine and what it did to energy prices. I'm here to tell you, had a lot to do with the government's fiscal policy, overstimulating the economy by injecting $15 trillion into the economy to combat COVID.
Yep.
Most of the economists I talk to say that the second stimulus package was probably overkill. And at the same time, the Federal Reserve started buying up mortgage-backed securities, dropped interest rates to zero, and doubled the monetary supply. And when you double the monetary supply and do those other things, you're going to wind up with inflation.
Yep.
So they got started fighting it a little bit too late, which is why they had and they said this, by the way, I'm not picking on them.
Yeah.
Chairman Powell did fess up to this. And because of that, they had to take unprecedented steps to
Corrective
raise the Fed
actions.
funds rate in order to get inflation down. It has been trending down, and now it's trending steadily down. I think the last report, we were at about 2.5%. So well on our way to the Fed's 2% target. Tomorrow's meeting, they will certainly reduce the Fed funds rate. I saw a story on CNBC this morning where the market is expecting a 50 basis points decrease, which a half a point decrease. I'm confident we'll see at least a quarter point drop. I'm not as confident we'll see a 50 basis points drop. If we do not, and the market's already baked that in, we actually could see mortgage rates tick up a little bit again. Not dramatically, but a little bit out of kind of a sense of disappointment that the Fed's not operating more quickly. Now, keep in mind that the two things the Fed is watching when it looks at the Fed funds rate, one is the rate of inflation, which is coming down, and the other is the kind of relative heat of the jobs market. So inflation coming down and the jobs market settling down a bit, unemployment going up just a smidge, all pointing toward the Fed reducing the Fed funds rate pretty significantly as we get through the latter quarter of this year. But I don't know how big that drop is going to be in tomorrow's meeting. And again, if it's only a quarter point, don't be surprised if we see mortgage rates tick up 1/10 of a point or so while the market kind of recalibrates. Mortgage rates have declined and they're down to the lowest level in about 2 years. And this chart from Mortgage News Daily looks at their rate, looks at Freddie Mac's rate, and looks at the Mortgage Bankers Association rate, but they're all down. Most recent number, I think yesterday, was 6.12% on average for a 30-year fixed rate loan for your prime borrower. And what I did want to point out, though, is even though these rates are the lowest they've been in 2 years, they're still twice as high as they were back in 2022. So we do have to keep these things in perspective. And there's probably, Carl, somebody old enough in the audience to say, yeah, but back in 1980, they were 18%, so they're only a third of where they were back then. And that's true, but your average house was selling for $75,000 instead of $400,000. So everything's relative. Here's the other thing I'd point out to you, and we'll talk about affordability in a second. Keep in mind that the difference between a 7% mortgage and a 6.5% mortgage on a $300,000 loan works out to about $100 a month. So it's really not an affordability solution. If $100 a month makes the difference between you buying a house and not buying a house, you probably can't really afford it. And not to be cavalier about it, but until we get these rates back under 6, I don't think we see a significant jump in home sales activity, certainly from a seller perspective, but even from a buyer perspective. We're seeing more buyers, but we're not going to see a tsunami. Because of this, purchase loan applications, and you guys are probably painfully familiar with this, are still down about 10% year over year. They've been ticking up and down week over week. I don't pay much attention to the weekly numbers, but
Hmm.
I do tend to look at the year-over-year numbers. Most of us have been hopefully thinking that we'd see a slight uptick in existing home sales this year. But none of the forward-looking predictors like purchase loan applications, like pending home sales, are predicting that right now. In fact, pending home sales, if you look at the way they tend to track over the course of a year, are suggesting we're going to come in probably just below 4 million existing home sales for all of 2024. We finished just slightly above 4 million a year ago.
Hmm.
The most recent NAR numbers for July came in at 3.89 million on an annualized basis. So we're likely not to quite
Close.
do what we did last year. We'll be close, but that'll still be the lowest number of existing homes we'll have sold probably in the last 20 years.
Mm.
Good news is there is still room for mortgage rates to decline based on historical spreads. And for those of you who don't follow this, I'll give you just a quick Reader's Digest version of what we're talking about here. If you track yields on 10-year US Treasuries, on 10-year bonds, um, there's usually they usually run in direct correlation with 30-year mortgage rates. So if you have a 4% yield on a bond, typically a mortgage rate will be 1.5 to 2 points higher than that. So 4% yield equals a 6% mortgage, or a 6.5, I'm sorry, equals a 5.5 or a 6% mortgage.
Hmm.
Since COVID and since the Fed started raising rates, that spread has jumped to about 3 points. And even today, we're still at about 2.6, 2.7 points. So we could come down, if we just got back to a more normal level of spreads,
Hmm.
we could get down almost immediately to mortgage rates that are a
Fives.
0.5 point lower, or even a full point lower than where we are today.
That would be nice.
And 10-year treasuries are trading at some of the lower numbers we've seen in recent years. I think today they're right around 3.6. So again, in a normal market, mortgage rates based on that 3.6 would be somewhere between 5.1 and 5.6%. So we could come down significantly from where we are as the market settles down. I've been saying for the better part of a year now, I didn't believe that spread would start to come down until the Fed announced its first cuts. And that's going to happen in September. So I think that'll help a little bit. There's a whole bunch of things that go into this. It's the price of mortgage-backed securities because the Fed's not buying those anymore. There's a fear in the market about prepayment rates going up as mortgage rates come down. So there's a whole bunch of things that go into these spreads. But bottom line is, if you're just looking at the way things have happened historically, it could get better before it gets worse.
Mm.
One of the other factors that goes into affordability, of course, is home price appreciation. It's still going up, but it's going up more slowly. So the most recent Case-Shiller index came out yesterday, and the national index had
Oh, yeah.
rates going up just below 5%. The most recent NAR numbers had a very similar year-over-year price increase of a little over 4%. So Freddie Mac's report came out about a week ago. They're in the same area. And historically, if you look at things on average, home prices average going up about 3.5 to 4% a year. So it seems likely that by the time we get to the end of this year, we will be back down in that kind of range, 3.5 to 4% year-over-year price increase
Hmm.
on the median price of a home. And that's good because wage growth is actually happening faster than that. So for the first time in quite a while, wage growth is actually outpacing the rate that home prices are going up.
Yeah, that's good.
Some other good news from an affordability perspective, if you look at data from Altos Research that measures things weekly in terms of contract closings, what they're showing, and it's a little hard to read here, but the dark red line at the top of the group here shows that prices have slowed down significantly, and they're actually flat year over year. They've been running anywhere from 3 to 5% higher than last year up to this point of the year, but in today's market, literally as recently as last Friday, the prices had flattened out. One other piece of good news, if you look at things from a buyer's perspective, from an affordability perspective, so if you look at current sales, Almost 40% of home sales have had a list price reduction before they've sold. And the longer the properties are on the market, the more significant that list price reduction is.
Yeah.
Keep in mind, most list price reductions on closed sales are not massive. They're generally between 1% and 5%. The outliers are maybe as high as 10%. But that being said,
No fire sales are going on.
yeah, and there are some going on, but keep in mind, for all of you who are being scared to death by all the crazy people on YouTube predicting a house price crash because affordability is so bad, ask yourself this: if you don't have to, are you willing to reduce the price of your house by 20 to 30% in order to sell it? And the answer for most sane people is no, of course not. I'll wait. And that's what most people are doing. They're waiting for market conditions to improve. Um, we are seeing an early decline in the number of list price reductions. I think that's because people that are listing their homes today are doing it more rationally from a pricing standpoint. I also think it's because mortgage rates have ticked down a little bit. So suddenly that buyer can probably afford a little bit more
Yep.
and isn't fighting as much.
The lock-in effect is sort of releasing itself a little.
Well, we'll talk about that in a minute. But yeah, it is releasing itself a little. So the bad news after that good news is that when you look at relatively high mortgage rates and relatively high home prices, they combine to really equal some of the worst affordability on record. This is data through May. It's probably improved a smidge since May, but from the Atlanta Federal Reserve Bank. And with their index, if properties are affordable, they are at or above 100 on the index. And their most recent report came in at 68.3. So not at all affordable if you look at things historically. When interest rates dropped, even though prices were rising as fast as they were, you can see that properties were still relatively affordable. But once those rates doubled in 2022, you can see how massive an impact that had on affordability levels. And this will just take time to work out. So we're not likely to see home prices crash, or they probably would have already. We will gradually see wage growth eat into affordability. We will gradually see home price appreciation slowing down a little bit, and we will gradually see mortgage rates decline. And those three things combined over time will make affordability better, but it will take time. So spoiler alert, my view of the housing market for the next 2 to 3 years is probably relatively weak sales continuing and relatively slow home price increases. So it will get better, but slowly and gradually. That's basically, we've gone through this wave several times over the last few decades, and every time we have this kind of reset, that's kind of how the market behaves. Something else for you all to consider, and this is one of those, they say high blood pressure is the silent killer. I think high insurance rates are now the silent killer for the housing market and the mortgage industry. We are seeing rising insurance rates becoming a real challenge when it comes down to affordability. Carl, you're in Florida, which is ground zero for all of this.
Mine jumped
Florida,
15% over the year.
It's insane. And there's more bad news for you. There's virtually nowhere in the country where this is not going to be not going to have an impact. And the reason I say that is, as rapidly as the insurance companies are trying to raise premiums in places like Florida and Louisiana and Texas and California, they're simply not going to be able to raise them fast enough and high enough to offset all of the losses that they're dealing with right now.
Yep.
And that's basically how insurance works, by the way. Everybody pays into this pool. And sometimes if you're in a market like Madison, Wisconsin, where there's not much going on, you wind up paying a little bit more for people that are in Monterey, California, or Naples, Florida. And it's just the nature of the beast. So everybody's insurance rates are going to go up a little bit. But if you look at markets that have a high incidence of extreme weather events, like California and Texas and Louisiana and Florida, that's where you're going to see them go up the most. And I've talked to some people anecdotally, particularly condo owners in Florida, who are now paying more for their insurance on a monthly basis than they are for their mortgages. And it's just, yeah, there you go, Carl. And it's crazy. So when you're working with a borrower, you really need to take a look at where they are and if they're going to be able to get insurance, which obviously is mandatory for a mortgage.
Yep.
And if they are able to get insurance, what it's going to cost them, because that really gets to their debt to income ratio, their ability to repay ratios. So you really need to be paying much more attention to this than you ever have in years past.
Yep.
So with all of this, probably not a surprise that existing home sales continue their slow but downward trend. July marked the 36th consecutive month where we sold fewer homes than we sold the prior year. I've been in the industry now for 25 years. I don't recall another period where that's happened for 36 consecutive months. So it's a bit of an anomaly, but I'm hoping we're bottoming out right now and we'll gradually start to see things recover. July sales, by the way, were a little better than June's. And that's a good sign, because prior to that, we'd had 4 months in a row where sales were also down month over month. And keep in mind that if you go back historically, the biggest months of the year for home sales typically were spring and summer.
Yep.
So the fact that we're seeing month to month declines during the spring and summer and year over year declines tells us that the seasonality component really isn't working the way we'd expect it to. And that really is because of affordability and because of limited availability.
And
And
the seasons are changing a lot too because of climate change. You don't have those
well,
as
that's
long
true.
elongated windows like we used to.
I'm talking to you today from Southern California. I'm in Orange County, where a
Yep.
wildfire broke out 4 miles from my house on September 9th.
Yep. I remember when we talked.
24,000 acres consumed. And I've been telling people since I moved out here years ago that there are 4 seasons in Southern California, despite what you hear from other parts of the country. We don't have winter, spring, fall, summer, and fall.
Fire,
We have
flood, mud,
yes, we
quake.
have spring, summer, wildfire, and mudslide, and we're in wildfire season now. But it is a factor.
Shake and bake.
So inventory is also a factor. The numbers are improving, but still pretty weak. And I thought this was a good way of showing it from Altos Research. Current inventory of homes for sale right now is about 704,000. You go back to 2019, that number should be closer to 1 million. And prior years, it's been about that. There is some seasonality there too. But inventory in a normal balanced market of existing homes for sale gives you about a 6-month supply. Right now, we're looking at about a 3.5 to 4 month supply. So getting better off the bottom we saw a couple of years ago, but still fairly weak. And only 4 states, in fact, have recovered to 2019 inventory levels: Florida, Texas, Tennessee, and Idaho, of all places. So we are seeing gradual improvement. Those states that are in kind of light green, that lime green that you used to see in your elementary school when they painted the walls.
Yeah.
Those are the states where we're seeing inventory come back. But if you look at the Northeast, if you look at California and Nevada and New Mexico and some parts of the Midwest, still well below where we were back in 2019. And new listings continue to lag. This is what Carl mentioned about rate lock before. So remember I told you that inventory is up, I may have mentioned this, up almost 40% on a year-over-year basis. What's interesting though, Carl, is that new listings are only up about 5%. So how do we have 5% new listings and 40% increase in inventory? Well, it's for 2 reasons. It's one, once something hits inventory, it takes longer to sell. And 2, demand is slowed down, which is one of the reasons it takes longer to sell. So we're not seeing that inventory increase dramatically because of a whole wave of new listings. And that's because of rate lock. So 3/4 of all people with a mortgage still have an interest rate under 5%. And I can't emphasize enough that this is not a question of homeowners being picky or there being a psychological barrier to trading in a 4% mortgage for a 6.5 or 7% mortgage. But if you're sitting on a 3.5% mortgage, which by the way, about 35% of homeowners are, and you trade that in for a 6.5% mortgage on a slightly more expensive house, you've effectively doubled your monthly mortgage payment. And most people simply can't afford to do that. So Again, consensus among the economists that I talked to is this rate lock will continue to be a problem until we see mortgage rates down probably below 5.5%. At that point, borrowers will be able to rationalize and financially compensate for that slightly higher rate of mortgage. But until then, what you're going to have on the market, for the most part, are people that feel like they need to sell for one reason or another. There's a birth in the family or a death in the family. There's a job loss or a new job with a transfer. There's a marriage or there's a divorce. There's a sickness or something else that unexpected financial difficulties. So
Their homeowner insurance has gone up too much.
yeah, well, actually,
And there is some of that in Florida.
We actually are starting to hear about that anecdotally. People simply can't afford their home anymore because their insurance and their property taxes went up.
HOAs and property taxes.
So, with property values going up 40% over the last few years, those taxes come up too. So, so much for getting that 30-year fixed rate mortgage and knowing what your monthly payments are going to be forever, right?
Yeah.
So we will see gradual number of these properties come to market. You also have boomers who have been aging in place who eventually are going to move out of their homes and bring those properties to market. And a lot of those boomers just have massive amounts of inventory or of equity. Maybe aren't going to buy a new home, so they're okay with the higher rate issues.
And there's a higher trend now of them wanting to age in place and not go to
yeah
other places. So that's
boomers
it's
have been
impacting
incredibly stubborn
inventory.
about that, and that does present some cash out refi opportunities because in a lot of cases they'll tap into their equity to renovate their home to make it more livable while they're aging in place. So you have to look for opportunities when they present themselves. But bottom line is this is why I'm expecting the next couple of years to be relatively slow. Also worth pointing out, I really like these charts. The increased inventory, when it happens, completely changes the market dynamic. So these are two different reports from Resi Club. And Resi Club, by the way, is a free newsletter. They have a paid one, but the free one is definitely worth subscribing to because Lance puts out a ton of really good information. And whether or not you like Zillow's reports, it's at least one metric to take a look at. And if you look at the chart on the left, you can see, if you remember where I showed you inventory was still lower than it was in 2019, you can see that those are still really strong sellers markets because there's just not a lot of inventory available for the buyers that are there. If you look at other markets, and surprisingly now we're looking at markets like Texas and Florida, which have been a little bit overbuilt in the last couple of years, you're seeing that they're actually starting to move toward either equilibrium or buyers markets. And you have markets like Punta Gorda, Florida, and I just like pointing that out because I like saying Punta Gorda, where prices are actually down on a year-over-year basis. Same thing we're seeing in states like Idaho, where prices went crazy during the pandemic as everybody from California moved to Boise. Same thing with the chart on the right. The sale to list price ratio. Anything that's in blue there is selling for a little bit more than original list price. Anything that is in red is selling for a little less than list price. So, I showed you overall list price reductions earlier, and keep in mind, normally we have about 33% of homes sold that have a list price reduction. So it's not like this is a new phenomena. But it really does, it varies by inventory. So as we see more inventory coming to market, things will be better for buyers and a little bit easier for sellers.
Can you go back to that chart for a second? Because there was a question that had been submitted by somebody who RSVP'd earlier, just to see where you think things are going in the Southeast. This person was asking specifically about Chattanooga, Tennessee, but just what you're seeing in the Southeast in general here. I think these two charts, cover that pretty well.
I think in the long run, the Southeast is still a good market to be playing in. We still have a lot of population migrating there. I didn't include those charts, but we are still seeing a fair number of people move from high cost, high tax regions into lower cost, lower tax regions, and that typically means the South and the Southwest. So I'm still bullish on Tennessee and the Carolinas. Surprisingly, Alabama seems to be doing pretty well. And despite some of the things you're seeing on these charts, the upper northern part of Florida, from about Central Florida up, is still actually doing pretty well as well.
That's where I am.
I do think there's a little bit of overbuilding going on in the state, particularly when it comes to condos. But that's kind of typical for Florida too. And Florida last year was the state that had the most population migration from other states. Also had the most activity from out-of-state real estate investors buying properties and either flipping them or converting them to rentals. So I still think the Southeast is a good place to be playing, particularly if you're a rental property investor. But going to be I think there's going to be a lot of lending activity in those regions.
Okay. Right. Sorry.
That's all right. Just be careful with the pricing because of what we're talking about right now. And this is some information from Resi Club through John Burns Research. Still showing a different way of looking at what we just looked at. The Northeast, Southern California, parts of the Midwest are still skewed a little bit more heavily toward being sellers markets. Whereas if you get to the bottom of this chart, Florida, Texas, parts of the Southwest are moving a little bit more toward sellers markets. And that's all inventory related. New home sales are working differently than existing home sales. They jumped in July on an annualized basis, about 739,000. I am 100% certain that number is going to change when it's reported on next month, because new home sales are always an estimate. They're always adjusted. This one will probably be adjusted down, but it's still a big jump, a big number. I would not be at all surprised if we get close to 700,000 new home sales by the end of the year, because people are increasingly looking at those new homes instead of existing homes. How much so is that new homes are now accounting for about 16% of overall sales. In a normal market, that number is usually closer to 10 or lower. So the fact that we're seeing that much activity is pretty significant. There are a couple of reasons for that. One is that inventory levels are back to actually normal or a little bit more than normal. There's about a 9-month supply of new homes available for sale. Now that counts homes that are completed and homes that are under construction, which is the red and blue areas on this map. The green area is basically homes that have been permitted, but ground hasn't been broken yet. So there is more availability of new homes for sale. They are generally more available, by the way, in the South and the Southeast than they are in other parts of the country. Very little building activity going on in California or in the Northeast. The other is, and this is a kind of surprising phenomenon, the median home price of new homes is actually a little bit less than the median price of existing homes that are for sale. That almost never happens. So that gap between new homes, which are usually more expensive, and existing homes has basically vanished. Now, this is where data can be a little misleading. Keep in mind that I mentioned the builders are in fact building smaller homes or building less expensive homes, but they're also primarily building in less expensive markets. So when you start doing things like medians and averages, you have to take that into account. There are still existing home sales where properties are for sale in Washington, D.C., and San Francisco and New York, places where there's no new homes being built. So that does skew the numbers a little bit. But that aside, the fact that we have that minimum amount of a gap is crazy. Home builders are also selling increasingly to investors, which is a bit of a surprise, and they're selling nationally to 60% of them are selling to investors nationally. Mostly to investors who are buying homes to rent, by the way. Fix and flip investor has a hard time making these numbers work, but if you're Pulte Homes sitting on three homes at the end of a development that you can't get rid of, investor looks pretty good. And keep in mind that investors today account for about 30% of all residential home purchases.
And they're cash buyers too.
If you're not talking to investors today, you're missing out on a third of the market. So keep that in mind. The other thing I didn't include in here is builders are also doing a bunch of concessions. On average, they're doing concessions that are equal to about 5% of the purchase price. And they're also in many cases coming to closings with cash, where they're paying points on a mortgage to get that rate down below market rates. So a lot of reasons for people to be actively pursuing new homes. rather than existing homes in the market. And builders are on pace to complete over 1.5 million new homes this year. Recent housing start numbers were down a little bit month over month and year over year, but the completion numbers are still pretty strong. So builders are not quite meeting need yet. They're getting closer than they were coming out of the Great Recession, where they underbuilt consistently for about a decade. But they are starting to close the gap a little bit. The most recent numbers were a little disappointing, but that's also because builders are very sensitive to what's going on in the market right now.
Yeah.
When they see less traffic, people looking at the homes, when they see people with a little bit less buying activity, when they see price fluctuations going down rather than up, that builder's confidence index dips a bit. And when that dips, you see construction slow down.
Yep.
So we'll see how things play out over the fall as financing costs hopefully come down a bit.
Yep. It costs a lot of money to keep those empty lots, though.
So just to kind of recap some of the stuff that we talked about today. Existing home sales at their lowest point in over a decade. We're probably going to end this year under 4 million units sold. Hey, that's still 4 million units, most of which require a loan, but it will be the fourth consecutive year where home sales were lower than they were the year prior. New home sales are relatively strong. They would probably be even stronger if builders would build more, but they're a little reluctant to overbuild, so they're being very careful. I do not believe that mortgage rates will decline rapidly this year, but I do think they will continue to decline slowly and steadily, not just through the rest of this year, but through all of 2025. And most of the economists that I follow or talk to are definitely predicting rates into the fives by about the midpoint of next year, and perhaps down to even to the low fives by the end of 2025. So things will start to feel better as we go forward. I mentioned that the Fed's likely to cut rates not next week, but tomorrow. The reason I don't think you'll see mortgage rates drop as soon as they do that is because I think the market's already built in that rate cut to the mortgage rates that we're seeing. Might be a lot of HELOC and refi activity available as rates decline, and people tap into that equity with more favorable rates. Keep in mind that, as I mentioned earlier, consumer debt's at an all-time high. Interest rates are at an all-time high. HELOCs are a great solution. Cash out refis in a lot of cases or home equity loans can be a great solution for those households that are having trouble with that debt load. Price appreciation for houses across the country right now is either on par or below annual wage growth, which again will be an improvement in affordability over time. And as we do see increased inventory and weaker demand, it makes for an improving ecosystem for the buyers that are out there. So if you have fewer people to compete with and more inventory to choose from, and that will have an effect on prices, make it a little easier for the buyers that you're working with to be able to find something that they can afford to buy. And I know that last line, that was a confusing line if I didn't explain it.
No.
But I wanted to explain it.
No, and I think you've also indicated there are a couple other opportunities if people are willing to look for investment properties, and then kind of based on the traditional income model, that there's a lot of people that can take advantage of alternative income documentation, mortgages, whether it's BOEs, bank statement, DSCR, that kind of stuff. So there's a lot of opportunities in the non-QM space, and that's been a pretty consistent message from most of the economists that are out there. So that's always a good thing for people that are working with non-QM lenders. Not that I know one in particular, such as ourselves. So it does bode well for those people who are working with us and want to be working with us, or more importantly, should be working with us. So I don't see any questions come in through the chat yet, but let's as soon as I say it, make it happen. Let's see what the question is that just popped up.
Oh, for God's sakes. Okay. Have public and private investors weakened the mortgage market for today and potentially into the future due to pushing out first-time homebuyers?
Institutional investors.
Yeah, it's one of the most popular memes in the world today, and actually a point of debate in Congress and in the upcoming elections. Um, that these big investors or that Wall Street is gobbling up Main Street. And the fact of the matter is no. If you actually look at the number of single family rental units that are owned by investors, over 90% are owned by mom and pop investors who own 10 or fewer properties.
Mhm.
There's a middle tier of investors who might own 100 or a few hundred properties. And then you have the big institutions, the Invitation Homes, American Homes for Rent, Amherst, Tricor, Progress,
Mhm.
or Tricon and Progress. Collectively, all of those big institutions own about 3% of the inventory. And they've been keeping their powder dry over the last year and really not buying much. In fact, most of those institutions on a net basis have sold more properties this year than they bought. But it is a very popular meme and notion. The other thing I can tell you from talking to some of these folks is they are deploying their capital very differently today. Instead of going out and competing with home buyers for an individual property, they're now working with builders to do ground up construction of rental communities, not multifamily units, but single family units in a community that are being built specifically for the purpose of renting.
Mm.
And we're seeing more of that activity going on right now. And if I were an institutional investor, I would wonder why I hadn't been spending my money doing that all along. It just gives you much more certainty over pricing. It gives you much more transparency into the quality of materials, the workmanship involved, what your maintenance costs are going to be going
Mm.
forward, and you have all the properties together. So it becomes a lot easier to manage those properties and by buying one in Decatur and one in Atlanta and one in Smyrna and trying to figure out how to manage all of those disparate properties. So no, I think what we are seeing is the investors have shifted gears. They're actually now adding inventory to market
Mm.
rather than competing for inventory. And if you look at most markets for real and see who's been buying the properties, it overwhelmingly has not been the investors. The the uh, the mom and pop investor market has been with us forever.
Mhm.
And it continues to be the bulk of the properties that are available out there. There are other investors.
It's all the guys watching Property Brothers think they can fix and flip a house and hold on to
Well,
it and rent it.
interestingly, Carl, interesting you brought that up. Flipping activity has actually come back a little bit last
Mhm.
quarter after dropping for several quarters consecutively. And I don't view those people as competing with homeowners either. If you
Mm.
see most of the properties they buy, um, you would never put a first-time homeowner in one of those properties.
No, without a lot of
Um,
tax incentives.
it's just that they're usually in a state of disrepair, and most of us, aren't exactly Bob the Builder who can go in or Bob Villa and can go in and fix these properties up. So they're taking mostly vacant properties that require a lot of repair,
Mm.
bringing them up to move-in condition, and then making them available on the market. So, in a very real sense, those
They're
investors
adding
are actually
inventory.
increasing inventory. So,
Yep.
I've never bought into the notion that investors in large numbers are pushing home buyers out of the market. There are exceptions. If you look at the Atlanta market, investors probably own about a third of the properties in that market over the last couple, or they bought about a third of the properties over the last couple of years. But Atlanta's an outlier. There are a couple markets like that, but mostly no.
Mm.
That was a really long answer. I apologize.
No, that was good. That was a good question though, because that is the big perception that I've seen out there. So thank you for helping to address and hopefully dispel it to a certain extent. Okay, so we'll try again. We'll see if we get more questions. Um, you want to share the rest of our slides, my compatriot behind the scenes, and then I'll buy us a couple minutes here for some folks to come up with some more questions. So as we kind of talked about through the course of this webinar, A&D Mortgage really is here to be your partner for growth. We do this through kind of a couple of different ways. We don't talk about it as much on this as we do in some other webinars, but we do have a pretty centralized, streamlined loan process. So we really want to kind of cut through the red tape and the paperwork and make everything as fast and easy for the brokers and their borrowers. Um, and it's backed up by our team of underwriters and capital markets people and processors and sales executives, you name it. We usually hire experts in our fields, and we're always here to do whatever we can to get your borrowers to the closing table. And then with that partnership we talked about with Imperial Fund, it gives us the ability to create our own underwriting guidelines for our non-QM products, and that allows us a little bit of flexibility in how much risk we're willing to take with those types of borrowers. And then we also, the last real big component, of course, is to promote broker education like we do through these webinars. And we've got 2 more coming up. So we're going to do a deep dive next Thursday on asset-backed securitization. Sorry, asset-backed securitization, asset depletion loans or asset utilization loans, depending on how you term it. So that's pretty good, especially for those high net worth borrowers and maybe those investors that we're talking about earlier. And then the beginning of October, we have our sort of standard broker orientation that we do for people who either just joined us as broker partners or might be still on the fence and want to know a little bit more about what it's like to work with us. In that one, we do a deeper dive into specific products and the specific technologies and services that we offer to our partners. So if you're on this webinar, you like what you're hearing and you're not sure yet, it's low risk. Go scan the code for becoming a partner, fill out our broker package. It's pretty quick. Get approved, and then you start giving us a shot. It looks like we've got another question that popped up. So,
Yep.
who are the higher than average percentage of all cash buyers seen in the existing home reports from NAR each month?
So great question, and kind of related to the previous question. Two things to say about that. One is that obviously a lot of those folks are investors. A surprising number of those folks are actually existing homeowners who are leveraging the equity they build up in their current homes. In 2022, which I know sounds like forever ago, we saw, when I was at Adam Data, we saw an enormous increase in the number of people who owned one extra home. They usually don't get counted in the investor numbers because the industry usually doesn't start looking at somebody as an investor until they own 3 properties. Because the people that own 2 properties might just have a vacation home or a second home. A surprisingly high number of cash buyers are those people. Now, whether they're buying that property to use as an Airbnb or a rental property or something else, I don't know, but a lot of them are those people. So, and again, a lot of them are mom and pop investors in addition to the bigger investors. But the other thing to keep in mind about the NAR numbers, which are correct, is that the higher the normal percentage doesn't reflect necessarily more cash buyers. Cash buyers have been fairly consistent with their purchase activity. Traditional home buyers have fallen off due to affordability issues. So it's not necessarily that we're seeing more investor purchases or more cash purchases. It's just that they represent a higher percentage of the total number of sales, because a lot of traditional home buyers have kind of voted themselves off the island because they can't afford to buy anything right now.
Yeah.
So that's the other thing to keep in mind when you read about those higher than normal percentages of cash purchases. Great question, though.
Yeah, great questions. Okay, well, we are at the top of the hour, and so this is usually where we wrap ourselves up. Want to thank you again, and again, just a reminder, people will be receiving a copy of this recording, and we'd also ask you to take a few minutes as you go to log out. There's a brief survey. Let us know how we did, how you felt the information was, if there's any topics that you want either A&D Mortgage to cover in separate webinars, or we could bring Rick back to do a special deep dive topic on something of specific interest. And we always, again, you always give us good information. I don't think yet you've been wrong. So we really appreciate all the insights that you give us with your years of experience. And it's always good to see you again as always. So again, it's Rick Sharga, the CJ Patrick Company. We'll send his contact information in case anybody does have specific questions they want to ask Rick that they might not have gotten a chance to. And with that, we will kind of close this out for today, and I'll hope for a 50 to maybe a full basis point reduction tomorrow from the Fed. So, all right, thanks everyone have a great day.